Hey, this is Chris Phyllis, and in this video, I'm going to walk through how a home equity line of credit works and give you some tips on how to shop for the best deal. And let me know if you have any questions. Okay, so home equity line of credits can really be good, especially in cases of an emergency. And so I want to just take a quick look and take a walk through about what they are, how they work. So I've got a page up right now. This is just a breakdown of some current offers from different local banks that offer a line of credit. And so a line of credit is a little bit different from your current mortgage in that it's typically going to be an adjustable rate, and they're going to be tied to, it's usually tied to prime. And so you can go to the wallstreetjournal.com and you can see that prime is currently at 3.25%, and this rate can adjust. And so if we look at the history, this goes all the way back to 1955 here. You can see at one point prime was way up at 20% or so, and really ever since the early 2000s it did actually go up a little bit. 07 there to about almost 8%. I think it did hit 8%, and now it is currently down here at 3.25%. So they do occasionally move prime, and if you have been watching the news, the feds are talking about increasing the prime interest rate 3 to 4 times this year in 2022 here. Who knows if that'll actually happen. So what does this mean? How does it all work? All right, so home equity line of credits are going to be tied to prime, like I just said, and they're going to look at the total value and total equity that you have in the house, and they're going to look at what's called the combined loan to value. So they call it the CLTV. And so I'll just walk through a scenario here and then kind of give you some things to look at. There's a few main things to be aware of. So let's assume here that the lender says, hey, you can do up to 90% combined loan to value, right? And they're going to do prime. That's called your index. So you have 2 components. You have index and margin. So when you're shopping home equity line of credit, lenders, you're going to want to ask these questions, right? So the first one is what's the margin and what is the index? Kind of doing the same here. So usually, let's say that their margin is 1%. So they're saying, hey, well, we're tied to the U.S. Prime interest rate, which is currently 3.25%, which can change, but your margin will be fixed, and it'll be 1%. So we'll add 1% to whatever the prime interest rate is, and that will be your rate, and it can change monthly. So every month they'll look at this and figure out what prime is. If did prime change, and your margin is going to be fixed typically for the life of the loan, but that's something you do want to ask just to confirm. But yeah, that's how they work. All right, so your cap, now they'll also throw in a cap, and they may say the cap is 15%, and so what that means is that over the course of the loan, whatever prime does, if prime went to 14%, that would mean your rate is 15%, because you're always going to add 1 to prime, 1% on top of prime. If it went to 14.5%, your rate would still be 15%. Now, personally speaking, I really doubt that would ever happen. It can happen, but looking at the chart here, I think that would just be not likely at all. But all right, so let's see. So we've got intro period here. So let me kind of recap here. Now they're also going to do like a promo rate. So a lot of times they'll offer an introductory rate that can be below prime. And let's say that they offer a intro rate of 2% for the first 12 months, and then they're going to do no closing costs. A lot of them do no closing costs. They really just want to get you in the door, because a lot of these home equity line of credits are like through a local bank. You may not even have an account with them yet. This is one way that they can get you in the door and then start to get additional accounts, maybe an auto loan or anything else, savings account, etc. So, all right, so they do typically also have early cancellation time frames, and a lot of them will say, hey, we're not going to have closing costs, but if you close out the account within a certain amount of time frame, let's say 12 months, we will charge you, and we're going to charge you $1,800 for that. They also often will have a minimum initial draw. They may say, hey, the minimum you need to take out at closing is $25,000. And so these line of credits are like you will actually get a checkbook. And so this is It's a revolving line of credit. It is something that you can take money out on and write a check out for anything, groceries, whatever. It doesn't matter what you use it for, and you pay it back, and then that money then again becomes available. So it's basically like a credit card in some sense. The interest is charged differently, but in the sense that you can borrow money, pay the balance down, and then have access to that money again. There are some additional terms that go along with this. So I'm gonna kind of go over some of these here. So you got term. Let's say it's a 300-month term, which is 25 years, and the interest-only period. So I think I mentioned it here. The interest, a lot of these payments are just the interest. So they typically give you a 10-year period where you can draw on the line of credit, meaning you can write checks out, access those funds up, for the first 10 years. And during that time frame too, they will only require that you pay the interest only on it, which means that you'll have a nice low payment, but the balance will never go down. So you need to be aware of that. And some of them have balloon payments, meaning that, at the end of 10 years, you need to pay off the entire balance in full. Now that can be done a couple different ways. You can refinance it, you can take out another home equity line of credit, or you can just pay it off with savings. But you need to be aware that if you're only making interest-only payments, hey, your loan balance is not going to go down, etc. So you can usually pay extra each month. Usually there's never a prepayment penalty, but that's another good question to ask. And let's see, so amortization period, let's say that they do a 15-year amortization period. And so after the 10 years of saying, hey, you only do interest-only payments, after that, you will have your payments based off of principal and interest payment based on a 15-year payback. So whatever the balance is at that time is your balance. You will no longer be able to write checks out and increase your limit anymore, and your monthly payment will be based on a 15-year payback, principal and interest. Now that rate can still adjust typically based off of whatever the monthly prime interest rate is, and your payment will be adjusted accordingly, and to make sure that you have that loan paid off in 15 years. And these terms are going to vary, and so these are the things that you're going to want to get familiar with when you're looking at different lenders and ask these kinds of questions. And so let's give an example here. Let's say that your home right now is worth $400,000, and you have a mortgage balance right now of $280,000. So you currently have a loan to value of 70%. $280,000 is 70% of 400. You have a total of $120,000 in total available equity. And so if this lender allows you to go up to 90% CLTV, combined loan to value, that's gonna give you a home equity line of credit limit of $80,000. And you may not need to, well, in this scenario, we've got a minimum draw of $25,000. So at closing, they would actually require that you have a balance of $25,000 on it. Now, a lot of times you can just pay it off like 2 weeks after closing, a month after closing. You're not canceling the line of credit. Usually, you want to read the fine print and make sure of this, but you're really just kind of paying the balance down. So you can probably hack the system a little bit there. But let's say that you did want to access the line of credit and you did want to borrow $50,000. Maybe you have an investment that you want to make or something. Doesn't really matter at this point, but you're going to now write the check out or withdraw the amount at closing for $50,000, and now that money is in your checking or savings account, so you can do what you want with it. The intro rate is going to be that 2% for the first 12 months. The interest-only payment's only going to be about $83. Keep in mind, this does not pay down any of the principal balance on it. So you make $83 a month payments for the first 12 months, your balance at the end of 12 months is still $50,000. Okay, now I did a rough scenario here. And so just to kind of give you an idea of what these are over here. So you've got your first lien balance. This is the home equity balance of $50,000. You've got another $30,000 in available funds on the home equity, because the total limit is $80,000. And then you have $70,000 that is untouched equity or untapped equity in your home. All right, so now you've got a scenario here at month 13. Let's say that they raised prime. So prime right now, again, it's 3.25%. You can check this daily. And let's say that they increased it, and they increased it to 5% 1 year from now. So that would probably be a couple different interest rate hikes. They usually do it in 1/4% or 0.5% increments. They can move it larger, but a lot of times they just do it in 1/4% increments at a time, at maybe a 0.5% depending, but it's kind of a big deal for them to do that. So let's just assume that they did. You now have a interest rate of 6% because it's going to be prime plus 1%, and the interest only payment is $250. And this is based on these payments are based on your draw amount. So if you only had $20,000, your payment's going to go down or adjust accordingly. If you had $80,000, your payment would be this, $400. So let's just do $60,000. Interest only is $300. The principal and interest payment, if you did want to pay it off in 15 years, would be about $506 per month. And usually this is an optional payment for the first 10 years or so on most of them, but you have to, these are the questions that you need to ask and want to ask them. Some other questions that you can ask here, let's see, so we've got, what is the intro rate, and how long is that introductory, like promo rate period? Find out what the margin is. That's going to be your fixed margin. In this example, it's 1%, but find out what the margin is that they're offering. Is there a minimum draw? Is there a minimum average balance? So maybe they do say, hey, listen, you need to have a balance each month of X. Otherwise, we're going to, close your line of credit down or something, or charge you, basically. The other one is, do you have any annual fees? Sometimes they may have an annual fee. And then if there is a cancellation policy or period, find out those details. What's the time frame? What's the cost? How does it work? Etc. So the line of credit, though, is really good to get set up. And it's good to get set up initially before you ever need it. And, if you, do run into an emergency and maybe you are out of work, it is a lot harder to get a line of credit if you're not employed or if something happens, etc. So these are things that are good to have in place. And the worst thing that can happen is you never use it. Usually there's no cost for it, at least for the first year. And so maybe you never use it. Maybe you don't, month or year 2, you don't use it. You never used it and you sell the home or something. Usually at that point, there's no cost involved to close it out, or if there is, it's pretty minimal. And so it's kind of like an insurance policy, basically, just to have access to money when you need it, if you need it. And so that's some of the benefits. Now, there are some other hacks that people can do with lines of credit that I'll maybe do some other videos on, but this is kind of a quick little walkthrough of how it works. So I hope this helps. Let me know if you have any questions.